We all start trading with the dream to get rich quick. But will that happen? Over 90% of the traders lose money in the stock market. Let us find out the common mistakes we were doing. Welcome back to another episode of the Stock Market Learning Series. I honestly admit that I have committed all these mistakes personally, lost money, and learned a lesson not to commit these mistakes to stay alive in the market. 1. Gambling mindset. Many people consider trading as another form of gambling and take their trades without any logical reasons. Use any of the paper trading tools such as MoneyBuy and develop one or two winning strategy that works for you. A good strategy will help you to earn consistent profits from the market. 2. Trading based on news. We have several sources that provide a lot of information on the stock market, economic conditions, and the impact of political decisions on the market. News traders need to understand how certain announcements will affect their positions and the wider financial market. Additionally, they need to understand news from a market perspective, and not only subjectively. It requires expert skills, and it's better that we avoid news-based trading. Three. Day trading. Normally, 70% of the intraday traders do not last beyond the first year. For trading, never rely on tips, and do not overtrade. These are the mistakes we usually do in intraday trading. Gradually master to read charts and use the right indicator that will help you to make a consistent profit in day trading. 4. Hopping across different strategies. There are thousands of trading strategies available to trade in the stock market. Before jumping into another trading strategy, ask yourself a question. What is important for me in trading? Making money, or trading every pattern and system? All you need is one pattern to make a living. Agree? 5. Bad money management. Risk management helps you to cut down losses. It can also help to protect your account from losing all of its money. Before entering into a trade, we should calculate expected return and the amount of risk we can take on that particular trade. And we will never succeed in trading if our risk is more than the reward. An appropriate risk-reward ratio tends to be anything greater than 1 to 3. Six, dealing with penny stocks. Penny stocks refer to company stocks that cost, if not merely a penny, or pretty low amount. There are many advantages in investing in penny stocks. We can also see that many penny stocks that gave good returns in the past decade. But investing in penny stocks are very risky. They lack liquidity and have a high probability of fraud and the bankruptcy of the underlying company. Seven, averaging down strategy. Averaging down refers to the purchase of additional units of a stock already held by an investor after the price has dropped. It results in a decrease of the average price at which the investor purchased the stock. Example: let's assume you were investing in Reliance Capital from 2007. In 2007, stock was trading around 2,600 rupees. And today, you can buy the same stock around 23 rupees. Averaging down strategy looks effortless and attractive, but practically very difficult to make money. If a person can avoid these 7 trading blunders, he will be in the game. From here, it's all about running the winning trades, cutting losses quickly, and following proper money management rules are the 4 most necessary elements to generate good returns from the stock market. Share this video if you agree. Keep learning and stay safe. Thank you for watching.